Well, we just lived through the biggest financial crisis since the Great Depression, and Wall Street has changed because of it.
But what's being done to prevent this from happening again and wreaking havoc on your financial future? That's next on MoneyTrack.
MoneyTrack is made possible by the Investor Protection Trust. The Investor Protection Trust is a nonprofit organization devoted to investor education. Over half of all Americans are now invested in the securities markets, making investor education and protection vitally important. Since 1993, the Investor Protection Trust has worked with states across the country to provide the independent, objective investor education needed by all Americans to make informed investment decisions.
This is MoneyTrack with Pam Kruger and Jack Gallagher. Bringing you real stories and real experts to show you what works and what doesn't work when it comes to investing your money. This is MoneyTrack.
Hi, everybody. I'm Pam Kruger, and welcome to Season 3 of MoneyTrack. And guess where I am? Guess who he is? I'm in the center of the financial district in downtown New York, while my co-host Jack Gallagher is...
I'm in the heart of Sacramento, California, and for those of you who have never seen MoneyTrack, we focus on topics having to do with money, specifically your money, and how you can invest and protect it. Our goal here on the program is to help you become smarter about investing.
And so there are two different things that you should be doing.
Sometimes we do this by answering the most commonly asked questions, such as, how does our financial system work? Occasionally, this even involves a little travel.
And that's exactly why I'm in New York, smack in the middle of the most important financial center in the world. More than half the world's investment banking profits came from right here. In fact, 40% of all corporate profits originated right here. But that was before the biggest crisis since the Depression changed Wall Street. Turns out, some of the CEOs that ran this empire made some pretty terrible financial decisions.
And here's what I'm wondering. I know that Wall Street's been transformed because of the subprime mess, but now the dust has settled, and I have to tell you, from here, it looks and feels pretty much the same. Business as usual to me.
And Jack, that business as usual begs the question, how likely is it that another financial and economic crisis could happen during our lifetimes? Today, we're exploring the answer to that question. Take a look around. There really aren't a whole lot of people out shopping for high-end goods in New York City. In fact, things are still pretty slow here. A lot like the floor of the New York Stock Exchange.
I'd offer you 10 at 55.
Okay, thank you. That's a pretty good market. Doreen's still here trading on the world's most famous stock exchange, but this once fast-paced trading floor is dramatically different since the crash of 2008. Actually, it's pretty darn quiet around here.
There's no room at the moment, GPC, so it's pretty quiet.
Thousands of Wall Street financial jobs gone in the meltdown of 2008. Losses we haven't seen since the 1930s crash. So how have things changed right here?
I've been here 33 years, but last fall actually felt like this could be something that would take us into the Depression.
What in the world is happening on Wall Street?
This market is as volatile as you'll ever see.
Just broad-based declines across all of the major technology sectors.
676 points down.
Everything there completely wiped out. And the NASDAQ, everything and more has been completely wiped out.
We haven't seen anything like this probably since the Great Depression, I think it's fair to say.
It was a Wall Street earthquake that devoured the financial giants, some more than a century old. AIG, Bear Stearns, Freddie Mac, Lehman Brothers, all gone. Merged or bailed out by their rich Uncle Sam. Well, that's you and me, our tax money, because of all the bad bets they made. The only two left standing, Goldman Sachs and Morgan Stanley. Now you see that plane about ready to take off behind me? It's the fuel that's going to keep that plane in the air. Without it, that plane would crash. Well, it's the same thing with Wall Street. Those investment banks I just mentioned, they're continuously investing in new businesses. They're creating new jobs. They're keeping the economy flying. And without them, the economy loses altitude and crashes. And by the way, even smaller businesses will eventually need the services of an investment bank or venture capital if they ever want to trade their shares here on Wall Street. And despite all the biggest banks disappearing, Wall Street expert Dave Kansas thinks they won't be gone for long.
So instead of the big investment banks that we've seen, we're going to see a couple of big ones that still remain, Morgan Stanley, Goldman Sachs, UBS, and we're going to see a lot of little ones trying to fill the shoes that have been left behind by Lehman, Bear Stearns, and others.
Dave's a Wall Street Journal reporter who wrote the Guide to the End of Wall Street, how and what to do next with your investments after the crash.
A lot of people got caught in the downturn, overexposed to stocks, especially older people, and they should not have been. So there's been a return to fundamentals. A good diversified plan is really important, and sticking with that plan.
Meanwhile, the mood over here is downright conservative. The appetite for risk certainly has changed.
Yes, that has definitely changed. I think you're going to see new regulations, which, you need them in place.
We're going to see more restrictions on the amount of risk that banks and investment banks can take.
So what's an ordinary investor to do? Well, Sabrina's an options trader who says that despite any new rules, investors will be wise to ride out any storms.
Case in point, people that, at the end of the year and beginning of this year decided, that's it, I'm done with the market. They missed out on a huge, unprecedented rally that we've seen since March, and they were unable to take advantage of that, and that hurts.
But ordinary investors need to be assured that all that risk-taking at the top has really been wrung out of the system. Nobody wants to go through that again, not even the traders.
The meltdown has affected our job in that there's literally less activity and seems to be less overall interest in equities at the moment. The reality is that the damage that is done, both psychological and real, takes a long time to repair. It takes a long time to get those confidence levels back.
And that is the key. See, Wall Street's not just a place in lower Manhattan. It has come to represent the center of the entire global financial world. The question is, can confidence be restored?
All right, well, I think this is a really good time to test your knowledge of our financial system. And since we're talking about Wall Street, our MoneyTrack quiz question today is, what is investment banking? What's its purpose? Is it A, when big banks invest their own money, B, a way to help businesses raise money or facilitate mergers, or C, is investment banking when you buy stocks or bonds through your bank? We're going to have that answer in just a minute. But you know what? I need money, and as it turns out, this is the only bank in the United States without an ATM, so I'm going to have to find one.
Jack, you can only take out a certain amount from the ATM in one day. You know that, right?
I know, Pam. I can't get all $50 that I have in the bank out at once.
All right. Now I have a question from somebody who lives and works right here on Wall Street. Darvel.
Hey, Pam and Jack, I have a question for you guys. What's going to prevent all of the small banks from becoming as huge as AIG or Bear Stearns and the whole thing starting all over again?
Well, Pam, I finally got my money, and I decided to take a seat across from the bank here. And in order to answer our viewers' question, let's go back, 75 years. Now, if I'm right, just after the Great Depression, the remedy to fix a broken financial system was regulation, and the mantra was safety first. That's when the FDIC was established, so that our bank deposits would be insured if any banks did go under.
Yes, and it was 1933, and something called the Glass-Steagall Act that was also created for the sole purpose of preventing commercial banks from taking too much risk with depositors' money. The Glass-Steagall Act made sure that traditional banks couldn't take the same risks that investment banks were allowed to take, and that investment banks, on the other side, were not allowed to play banker and take in deposits.
In other words, it's kind of like you and me. I mean, how we're separated right now. You're in front of an investment bank, and I'm over here at the commercial bank.
Right, and separating the two, Jack, helped protect against any conflicts of interest.
But in the late 1990s, that law was repealed, so that protective firewall came crashing down, Over the last several years, commercial banks and investment banks and insurance companies, for that matter, have all been able to take the same degree of risk.
And you and I know experts hardly ever agree, but on this one point they do. When the rules relaxed, the playing field changed, and that's when banks started taking wild gambles. The result? Well, a whole new Wall Street.
So let's get to the heart of our viewer's question. How do we prevent the exact same crisis from happening again?
Well, let's hear from somebody who's been studying this issue in depth. Today, our Investing 101 guest professor is none other than Dr. Simon Johnson from MIT's Sloan School of Management.
So, Dr. Johnson, welcome. Now, before 1999, when the Glass-Steagall laws were repealed, was our financial system safer?
After the Great Depression, after all the problems of the financial sector that had manifested itself in late 1920s, early 1930s, we had a financial sector that was very tightly regulated and run on a safety-first basis, and it didn't, by the way, pay very high compensation relative to other sectors. Now, that was the 1950s, 1960s, 1970s. What happened from the 1980s was we allowed the financial sector to become deregulated. We encouraged them to take more risks, and they were able to pay higher wages and attract very high-quality people on the basis of that. We had a financial sector boom, and it went too far.
All right, now there's major reform in the works, as Dave Kansas just pointed out. Yet, I'm getting the sense that you don't think that this kind of regulation is the right remedy.
I'm concerned they're not pushing it hard enough. I'm concerned that the industry, the financial industry, is rallying and lobbying against it, and these people are very, very powerful. And the second thing is I think consumers need to be much more protected than they have been in the past. And on this point, there is some glimmer of hope because the administration has proposed a consumer protection agency with regard to financial products.
We're proposing a new and powerful agency charged with just one job, looking out for ordinary consumers.
Simon, when I think too big to fail, I automatically think AIG, Merrill Lynch, etc. Now, do you believe that no one institution should be allowed to grow that big? Or, maybe they should just stay small enough to fail?
I think any bank of any kind, any background, any culture that is too big to fail or perceived as being too big to fail by the government will get into trouble. Anything that's too big to fail is too big to exist. That is the key message. People have to focus on that, think that one through.
And again, the reason we're talking about these banks is that we're talking about a huge piece of the economy here. As you said earlier, Pam, the financial sector alone accounts for at least a third of the total value of the stock market and corporate profits.
And what's amazing is that Wall Street banks are still profitable while the rest of corporate America is struggling.
Yes, the financial sector was 40% of corporate profits. So of all corporate profits, all profits owned by companies in the United States, 40% of them came from the financial sector. That's amazing. Financial sector in this country, by the way, is quite big. It's about 9% of GDP, which is probably too big and probably not sustainable in and of itself. But for any sector, and historically, it had a share of corporate profits in the 10 to 15% range. To go up to 40% was really an indication that something was brewing that was not entirely healthy for the rest of the economy.
So it kind of sounds like economists, if they were left alone, maybe like you, might actually be able to fix this problem going forward.
Well, first and foremost, the people who are running Lehman, Bear Stearns, and most of the other firms were not savvy investors. They didn't understand risk. Irrespective of what they told you and what they believed about themselves and how the popular culture perceived them as being very smart, sophisticated people, they weren't. They completely messed up. They forced the government into this position where we throw in this enormous amount of bailout money and run up a big additional debt.
So for me and my friends here in Sacramento, sounds like business as usual unless and until we make some really meaningful changes and restore some of those safety systems.
This is the remarkable and I think rather scary point, which is despite all the problems we've encountered, despite the fact that these big banks evidently completely mismanaged risk, didn't even understand the risks they were taking on. And of course, some of them have collapsed, but those banks that have collapsed have been picked up and re-merged into other big banks. So it's business as usual.
Dr. Johnson, Dave Kansas just said that smaller banks are going to fill the gaps that are left behind by the big failures. But, I mean, what's to stop those smaller banks from eventually becoming too big to fail all over again, just like Darvell's question?
When there's a major problem or a catastrophe or a disaster or a big accident, for example, we have quite quickly an investigation, pin it down to 2 or 3 potential causes. You can't say definitively exactly which one was the main problem, but you know what the cluster of problems was like. And then there's a very pragmatic approach to try and make sure none of those problems occur individually or collectively again.
Beyond the immediate crisis in front of us to find out.
We haven't done that. We're not doing that for the financial system. And the big banks will be allowed to go back to running their businesses as they did before, which is very risky for them and their shareholders and incredibly dangerous for U.S. taxpayers and U.S. American consumers.
Thank you, Dr. Simon Johnson from MIT. Now, if you would like to read and hear more about Simon Johnson's view of Wall Street and what he feels everyday investors can do to help restore our financial system, just head to our website. The address is MoneyTrack.org.
Now, Pam, we've been talking about Wall Street investment banking, traditional banking. So let's answer that little quiz question we asked earlier. What is investment banking? What is its main purpose? Is it A, when big banks invest their own money, B, mostly to help other businesses raise money or facilitate mergers, or C, is investment banking when you buy stocks or bonds through your bank? Pam?
Well, Jack, the correct answer in a nutshell is B. Investment banking is primarily a service that helps businesses raise capital so they can grow, so they can buy other businesses or merge. So think of an investment bank as a sort of financial advisor to businesses. Now, investment banks can be big or small, but of course, all eyes lately have been on the biggies, like where I am today.
But you said earlier that Goldman Sachs and Morgan Stanley are commercial banks.
Absolutely true. In 2008, both Goldman and Morgan Stanley became traditional banks, and both get to continue offering full investment banking services to their clients.
Okay, so remember at the start of the show I mentioned something about protecting your money?
Yes, and we care a lot about that on MoneyTrack. So every week we share with you a story of how real people are being suckered into investing schemes that are not only way too risky, but in many cases outright frauds. And today we're taking you to Arizona, where one con artist played Catch Me If You Can for more than a decade.
He had taught seminary in the Mormon Church, and usually these seminary teachers are very well screened for their goodness, for their ability to influence the young people. Well, they got that part right. He certainly knew how to influence.
Dennis Cope represented to these investors that their money would be placed in various high-yield bank trading programs, and represented that they would be making returns of up to 120% a year.
My husband wanted to do it, and being newly married, and if you want to do it, we'll do it. It was his idea and my money.
He represented that these investments would be a no-risk, high-return, that their money would be placed in financial institutions that would not leave the bank, but would be used as collateral to be traded.
And we thought, well, we may not make all this interest, but at least our money's safe, which, in fact, it was leaving the bank immediately.
He was operating a classic Ponzi scheme where money was coming in, being diverted for personal use, and then making Ponzi payments back to those investors.
Well, he'd had secret meetings with different people making you feel like you were really special, and you couldn't tell anybody else about it, and you had to sign disclosures. He'd give you maybe 24 hours notice or something. I mean, if it was going to be in Las Vegas, then, man, you'd get on a plane, even if you had to get a last-minute ticket. There was just something about him that absolutely drew people. You would do anything for him. It was amazing. In the beginning, they do give out a lot of money, and then to continue to give out money, they have to continue to bring people in. But as things got more and more suspicious and no money was coming in, then he couldn't bring more people in, and that's when it started to collapse on itself. He had told people if they wanted to, they'd get their money back, and so I actually wrote for my money back. We kept waiting for our money, and I kept emailing him, why is this not happening? Why is this not happening? It was always, well, this has happened, you know it's going to come next week, so we just kept hanging in there. Never got a payment. Originally, when this wasn't turning out the way we thought Denny needs help. There were a lot of spiritual people in this group. I said, we need to start a prayer group. I'm going to collect the people together and see if we can get some group spiritual energy going here to help kick this over. Well, meanwhile, somebody sent us the email, all of his email addresses. So I just used these email addresses and I started contacting people.
When the investors in the Cope case started talking amongst themselves, they began to put the pieces together and realize that there was something seriously wrong here, and that initiated the complaints being filed. A lot of times victims become frustrated with the amount of time it takes for these cases to progress, and over time their support tends to decrease. However, that was not the case with Claudia Nelson. From the beginning through sentencing, she stayed active in this case.
The beginning, the pieces were small and I didn't really have a case, but I actually worked on it for several years until I had a case that really looked like something. I knew that the people would never get their money back, but I knew that there were hundreds out there that if we didn't put them away, they would be the next victims. If you find somebody that's excessively charming, excessively generous, particularly if they're part of your religious background or part of your ethnic background, maybe you just ought to look a little bit deeper.
Well, check out our website for the most common scams and how you can investigate and recognize whether the deal is real or a fraud. And on our next episode,
I will be back with you in sunny California and far, far away from Wall Street. All right, Jack, let's say we wrap this up by running through our little checklist of what we've learned today.
We do this every week on MoneyTrack, so cue that checklist. We learned that what happened on Wall Street really did impact me here in Sacramento. It's my investments, the value of my home, my credit card limits. So even though I honestly was not one of those folks who thought much about investment banks on Wall Street, I now have a better understanding about how things work, and even though there's insurance on my savings, going forward I might have to plan for more bumps in the stock market and even less credit in my name. So I'm thinking maybe I'll go back and put some of this money back in the bank. I might need it for a rainy day.
I'm going to agree with you on that one. All right, we also know that from Dr. Simon Johnson of MIT, the end of Wall Street as we've known it for more than 100 years could actually result in a better, stronger system. That is, if we can create reforms that actually work and learn from history and not let the very same pilots that crash the planes fly them again.
And we always leave you with 3 pearls of wisdom. The last one is to realize that you can and you should investigate any investment offers that come your way. And there are tools to show you just how to do that at our website. And again, the address is MoneyTrack.org. We will walk you through how to do a background check on your own broker or financial advisor. And that is it from here in Sacramento, California. Thanks for watching. Pam, if you need any money, I can run over to the bank and get you some.
I could always use $1,500 or $3,000, $30,000.
Anything up to $10 you can have. Seriously.
Save it. All right, we'll see you next time, everybody, on Money Track. So long from Wall Street.
You know what? I just might use that $10. I think I'll continue this education right up the street at the Bull and Bear.
Say, I like to take you go where I begin.
Oh my God, this is great. Okay. Oli.
Ready?
Ready? Pitch it, pitch it. That's the fuel that flies the airplane. Bad investment decisions, bad bull.
Okay, here we go. 3, 2,